All right, let's jump right in. Today we're going deep on deep value investing,
Deep value investing.
using Tobias Carlisle's Deep Value as our guide.
Yeah, great book.
So just for anyone listening who might not be, totally familiar, can you give like a quick rundown of what exactly we mean when we talk about deep value investing?
Well, I think the key is that it's not about chasing the sort of the hot stocks or the big winners.
Right.
It's more about finding those companies that the market has maybe overlooked.
Okay. The hidden gems.
Yeah, the ones
Yeah.
that are kind of unloved.
So almost the opposite of what the typical advice would be.
Precisely. Yeah, it's very contrarian.
Interesting. And Carlisle really emphasizes this idea of market psychology, right?
Yeah.
Like understanding how fear and greed can distort prices
Yeah.
and create these opportunities for value investors.
Yeah, and the sort of the idea that those prices will eventually revert to the mean.
Okay. Mean reversion. We'll definitely have to dig into that more later. But first, Carlisle mentions Carl Icahn quite a bit, who, for anyone who doesn't know, is like this legendary activist investor.
Oh, yeah.
And he's kind of a poster child for deep value investing.
Absolutely.
Can you give us an example of how Icahn has used this approach to make these incredible returns?
Well, a classic example is his investment in Tappan Stove Company.
Oh, yeah?
Back in I think it was the 80s.
Huh.
And back then, everyone thought Tappan was, going belly up, basically.
Jalen Company.
But Icahn, he saw something that everyone else missed.
Okay.
He saw, undervalued assets and a potential for a turnaround.
Okay.
So he bought a controlling stake, shook things up a bit, brought in new management, and ultimately he made a killing.
Wow. So that's like a real-world example of how powerful this approach can be.
Absolutely.
Now, we can't talk about value investing without talking about Benjamin Graham,
Right, the Godfather.
the OG. So for our listeners who maybe haven't read The Intelligent Investor, can you give us the SparkNotes version of Graham's key ideas?
Well, the core principle is that, there's a difference between the price of a stock and its intrinsic value.
Right.
And that's what value investors are trying to exploit, buying things for less than they're really worth.
Okay.
He also stressed the importance of this concept of margin of safety, which is basically like a buffer.
That's buffer.
Yeah, to protect you against the possibility of being wrong.
Makes sense. So you're not just buying at a fair price, you're trying to buy at a discount.
Exactly. You want to buy at a discount to intrinsic value.
And Graham was also a big believer in shareholder activism, right?
Oh, absolutely. He was a pioneer in that area.
Like he wasn't afraid to, get involved, challenge management,
Yeah.
push for changes if he thought it would benefit the shareholders.
He saw it as a way to protect his investments, to make sure that the company was being run in the best interests of the owners.
Okay. So we've got Graham, who lays this foundation for value investing.
Right.
And then, of course, comes Warren Buffett,
The star pupil.
who, arguably took these ideas and turned them into like this investing empire.
Oh, yeah, absolutely.
So how did Buffett's approach, did he follow Graham's playbook to the letter?
Well, he started out that way, very much influenced by Graham.
Right.
But over time, his approach evolved, particularly under the influence of his partner, Charlie Munger.
Ah, okay. So what did Munger bring to the table? How did their thinking differ from Graham's?
Well, Munger was more focused on the quality of the business
Okay.
rather than just, purely statistical cheapness.
So it's not just about buying any stock at a discount.
No.
It's about finding great businesses.
Yes.
Even if they're not, selling for pennies on the dollar.
Right. You want to find companies with a durable competitive advantage. Strong brands, good management.
So it's like a more holistic view of a company.
Yeah, exactly. You want the whole package.
And Carlisle talks about See's Candies as being like a turning point for Buffett in this regard.
Yeah, that was a key moment.
Can you tell us that story?
Well, initially Buffett was hesitant to buy See's Candies
Okay.
because the price seemed high.
It wasn't like a classic value play
Right.
based on, the numbers.
Right. But Munger convinced him that See's had this incredible brand loyalty, high returns on invested capital, and that it was actually a fantastic investment.
Even if it wasn't, a screaming bargain.
Exactly.
So it was a really important lesson for Buffett in terms of expanding his definition of value.
It absolutely was, yeah.
Yeah.
It showed him that sometimes you have to be willing to pay up for quality,
Okay.
and that the cheapest option isn't always the best option.
That's a great point. So it's not just about finding statistically cheap companies.
Right.
It's about understanding what makes a business truly valuable in the long run.
Exactly.
So we've covered a lot of ground already. We've talked about market psychology. We've
Uh-huh.
talked about the importance of intrinsic value versus price,
Yep.
and how even the greatest investors, like Buffett, have evolved their thinking over time.
Right.
Okay, so earlier you mentioned this concept of mean reversion,
Right.
which Carlisle really emphasizes in the book.
Yeah.
Can you unpack that a little bit? Like, why is mean reversion so important for deep value investors?
Well, think about it like this. Stock prices, they can go up and down in the short term,
Right, volatile.
but over time, they tend to, revert back to some kind of average.
Like a pendulum swinging back and forth.
Exactly, yeah.
So deep value investors are basically betting that those undervalued companies,
Right.
that their prices will eventually, swing back up.
Exactly. They're looking for those situations where the market has overreacted. Push the price down way below what the company is actually worth.
So it's like they're waiting for that pendulum to swing back in the other direction.
Precisely.
And hopefully, they're on board for the ride.
Yeah.
But that takes patience, right?
Oh, yeah. A lot of patience.
Because mean reversion doesn't happen overnight.
No, it can take years sometimes.
So you really have to have that long-term perspective.
Absolutely.
Now, Carlisle talks about a couple of different strategies for finding these undervalued companies.
Mm-hmm.
And one that he mentions is Joel Greenblatt's magic formula.
Yeah, that's a popular one.
Can you give us like a quick explanation of what the magic formula is and how it works?
Well, it's basically a quantitative approach to finding good companies
Okay.
at bargain prices.
Okay.
And it focuses on two main metrics.
Okay.
Return on invested capital
Right.
and earnings yield.
So high return on capital means the company is using its money efficiently,
Right.
and high earnings yield means the stock is cheap relative to its earnings.
Exactly.
So you're looking for like the sweet spot where those two things overlap.
Yeah, you want to find those companies that are both profitable and undervalued.
And Greenblatt claims that, if you follow this formula,
Mm-hmm.
you could beat the market over the long run.
Yeah, he's done a lot of back testing that shows pretty impressive results.
But I mean, is it really that simple? Like, is there a magic formula for investing success?
Well, I think it's important to remember that no strategy is foolproof.
Right.
The magic formula, it does a good job of identifying statistically cheap companies,
Okay.
but it doesn't take into account all of the qualitative factors.
Right. The things that are harder to measure.
Exactly, yeah, like management quality or brand strength or
Mm.
competitive advantage.
So you still have to do your homework.
Well, absolutely, yeah.
You can't just blindly follow a formula.
Right.
Now, another metric that Carlisle talks about that I found interesting is the acquirer's multiple.
Ah, yes.
How's that different from the magic formula?
Well, the acquirer's multiple. It looks at the ratio of enterprise value to EBIT.
Okay, so that's different from the traditional price to earnings ratio.
Right. It gives you a different perspective on a company's profitability.
Yeah.
And it takes into account the company's debt.
Which is something that, a lot of traditional valuation metrics don't really factor in.
Yeah, exactly.
And Carlisle, he has this great line where he says that the acquirer's multiple
Mm-hmm.
prefers companies holding cash and hates those with loads of debt.
He does, yeah. It's a good way to put it.
And I guess that makes sense in the context of deep value investing.
Yeah.
Because those highly indebted companies,
Right.
they're often the ones that are, facing financial distress,
Right.
which is what creates those deep value opportunities in the first place.
Exactly. So the acquirer's multiple helps you to identify companies that are financially sound
Right.
and have the potential to weather a storm, so to speak.
Okay, so we've talked about these quantitative strategies for finding undervalued companies.
Right.
But Carlisle also emphasizes the role of shareholder activism.
Yeah, that's a key part of it.
So how does activism fit into the deep value approach?
Well, activist investors, they're the ones who are willing to, roll up their sleeves and get involved.
Right.
They see these undervalued companies
Mm-hmm.
and they don't just sit back and wait for the market to recognize their worth.
Right.
They take action. They buy large stakes in the company.
Oh.
They push for changes in management or strategy.
So they're not afraid to shake things up a bit.
Not at all. No, they're willing to be the squeaky wheel, to
Yeah.
challenge the status quo.
And Carlisle gives the example of Carl Icahn's investment in Genzyme.
Yeah, that's a classic
He
example.
saw this company with great potential that was being held back by, some operational issues.
Right.
He launched a proxy fight,
Right.
won board seats, and ultimately helped to unlock significant value for the shareholders.
Exactly. And that's what activist investors do. They push companies to make the changes that are necessary to realize their full potential.
So it was really interesting how all these pieces fit together, Understanding market psychology.
Right.
Using these quantitative tools to find opportunities. And then sometimes even taking this active role in driving change.
Yeah, it's a multifaceted approach.
It's not just about sitting back and waiting for things to happen.
No, you have to be proactive.
So we've covered a ton of ground here, talking about identifying those undervalued companies, understanding market psychology, and even like the role of those activist investors.
Yeah, it's a lot to take in.
It is. But it seems like, one of the biggest takeaways from Deep Value is that, like, the real key is having this long-term perspective, right?
Absolutely.
That willingness to be patient and ride out those inevitable ups and downs of the market.
Yeah, deep value investing, it's definitely not for the short-term trader,
No, it's a marathon, not a sprint.
Exactly.
And Carlisle talks about this idea of being ownership conscious, right?
Right.
Like, it's not just about buying a stock. It's about becoming a part owner of a business.
Yeah, that's a really important mindset shift,
Yeah.
When you think like an owner, you start to, look at companies differently.
How so?
You're not just worried about, what the stock price is going to do tomorrow.
Right.
You're thinking about the long-term health of that business.
Okay, so for our listener who's, they're intrigued by this, they're like, all right, Deep Value, this sounds interesting. Where do I even begin?
Well, I would say, first and foremost, read as much as you can.
Okay.
Start with the classics, Graham's The Intelligent Investor,
Right.
Buffett's Letters to Shareholders.
But beyond just, reading and absorbing the theory, what are some, like, practical things that our listener can do when they're, actually looking at companies trying to apply these principles?
Well, one thing I would say is don't just rely on those superficial metrics. The price-to-earnings ratio, the price-to-book ratio.
The things that everyone looks at.
Yeah, those can be misleading.
Okay.
Dig deeper. Look at the financial statements.
Okay.
Analyze the company's assets, cash flow, debt levels. Try to really understand, what's driving the current market perception.
So it's like detective work, almost.
It is. You got to be curious.
And don't be afraid to, get your hands dirty, right? Like,
yeah.
talk to management, visit their stores, really try to understand the business from the inside out.
Exactly. Yeah, the more you know about the business, the better equipped you'll be to assess its value.
So deep value investing, it sounds like it's as much art as it is science.
Absolutely. Yeah, it's a blend of quantitative analysis and qualitative judgment.
And I think that's a really important point because, sometimes people get so caught up in the numbers that they forget that there's this whole human element to investing.
Right.
It's about understanding people, understanding psychology.
Exactly.
All right, so as we wrap up this deep dive into deep value, what's like the one key takeaway that you want to leave our listeners with?
I would say, deep value investing, it offers a path to potentially outperform the market.
Okay.
But it requires patience, discipline, and a willingness to be different.
It's not the easy road.
It's not, no, but the rewards can be, well worth the effort.
All right. Well, on that note, a huge thank you to our expert for joining us today and sharing all this wisdom.
My pleasure.
And to our listener, thank you for tuning in to this deep dive.
Yes. Thanks for listening.
We hope you found it insightful. We hope you learned something, and we'll catch you on the next one.